Before we get started, we just want to thank Old Republic Surety for sponsoring this episode of Let's Get Surety, as well as NASBP virtual seminars. For more information on Old Republic Surety, visit www.orsurety.com. Now on to our show.
You're listening to Let's Get Surety. Let me hear your bonding talk with Kat Shamapande.
Hey everyone, it's Kat Shamapande. Thanks so much for joining us for this episode of Let's Get Surety. Got with me today my co-host, Mark McCallum, CEO of NASBP. Hey Mark, thanks for being on.
Hey Kat, it's always my pleasure. Love to be here.
We're driving into some deep waters today. We're going to be talking about reinsurance.
Very deep. Yeah, I need to learn a lot more about that. So I'm really glad we have some good guests.
I am glad we do as well. So today with us to discuss reinsurance, we've got Brian Fiore, Senior Managing Director at Aon. Hey, Brian, thanks for being on.
Hi, Kat. Thanks for having me.
We also have Steve Haney, Division President, North America Surety, and Chief Underwriting Officer, Global Surety for Chubb. Hey, Steve.
Kat, thanks for having me.
Yeah, thanks for being on. We also have with us Jeff Ryan, Unit Business Leader, Financial Risk with Partner Re. Hey, Jeff, thanks for being on.
Hi, thanks for having me today.
Can you guys just tell us a little bit about yourselves and your organization? So, Brian, you want to tell us about yourself and Aon?
Brian Fiore here. I spent my entire career at Aon working in the surety reinsurance space. So really over the course of the past 16 years, helping clients protect their capital, place reinsurance transactions, and grow their business. When you first come out of school and you become part of a global reinsurance intermediary firm like Aon, nobody tells you what surety is, right? And like most people in the industry, when you're in school, I didn't know what surety was, but I had the opportunity to work with a mentor in the business that exposed me to the line of business and ultimately develop specialty expertise in a growing, diversifying product line that has opened up a lot of doors, and excited to be here.
That's interesting. Jeff, before we dive in, can you tell us a little bit about yourself and about Partner Re?
Sure, absolutely. So I've been in the surety business since the beginning of my career. My first job out of college in 1991 with the Seabrook Surety Company, and I was a home office underwriter in Bedminster, New Jersey. So go back a little bit. I've been on the reinsurance side for the last 30 years, always in the credit and, bond space, if you will.
Okay.
So kind of non-P&C business. So my expertise at this is, outside of the standard P&C channels. I run our financial risks unit, which comprises itself of credit insurance, political risk insurance, mortgage insurance, and surety bonds. And we write surety business in 39 countries across the world. We have over 80 treaties in place. We write $140 million of surety business, which I think is a broad representation of the global mix. And the U.S. piece is the biggest piece of that. So we're deep in the U.S. space. We run our business across all market segments, national, regional, and specialty underwriters. And we truly enjoy our partnership with the surety business.
So, Steve, can you tell us about yourself and Chubb?
Absolutely, but I'm not going to tell you when I graduated college because people can figure out how old you are based on that. So what I will tell you is I graduated from Penn State with a finance major and then got into, the insurance surety world pretty early on in my career. And really, the last 30 plus years have been with Chubb, Cigna, Ace, Chubb. So if they follow the story, I left Chubb to go to Cigna, Ace bought Cigna, and then Ace bought Chubb. So I ended up back where I started from, which is great.
That's funny.
Right? Yeah.
I'm a Temple University guy, so there's a little bit of a rivalry there, but we won't go into sports because Steve will beat me and all that with Penn State.
Well, so I think in case some of our listeners aren't really clear on what reinsurance is, I feel like that might be a good place to start. So what is reinsurance and what is its function?
So the simplest way to get into what is reinsurance is think of insurance for the insurance company. It's a way to transfer risk. So companies like Steve's offer bonds to principals throughout the globe. They need a risk transfer mechanism to help manage the volatility that's associated with that risk. So my role as the intermediary is to bring reinsurers together that have appetite to participate on what's been a historically profitable line of business in U.S. and global surety and partner that up with the capital that needs it.
That's right. No, I mean, that's exactly what Brian said. Like you start out with a finite pool of capital, and what you're trying to do is write against that, but you're also trying to protect, from what margins. So your losses, right? So that's generally why we, Chubb would purchase, reinsurance is to try to have some certainty around if something was to happen, what would that, what would the quantum be?
And also, I mentioned it plays a role in terms of your state filings and with the Department of Treasury. So Steve, could you explain what the interface is there?
So when we file our rates, right, and surety is a little bit not like insurance because it doesn't really contemplate a whole lot of losses in it. So we don't really embed in our rate filings a lot of loss. What we do is it's pretty much, I'll call it underwriting, almost fee for service. So we underwrite, we're almost 100% sure that we're not going to have a loss. And then we act as a guarantee to make sure a contractor would finish a project where the taxpayers are actually funding that.
Mark, that's a great question, though. When you think about what reinsurance does, often you go to transferring volatility, they're transferring of risk. But reinsurance is also a form of growth capital and helping companies get from point A to point B. And specific to surety, there's a lot of infrastructure challenges. We get more calls a day about the need for treasury list capacity, state licenses, and the use of reinsurance as a vehicle that helps some of our clients solve for those challenges and manage those regulatory requirements.
Hey, Jeff. So we've earlier heard a little bit about what specifically reinsurance is, but I would love a little bit more in-depth answer on why reinsurance in particular is important to the surety industry, particularly in today's climate.
Yeah, thanks, Mark. And that's a great question. Reinsurance is not a new concept in the surety space, but I think it's taken on a lot more important role in the last couple of years, especially as contracts get bigger, aggregation of risk gets bigger, individual contractor work programs get bigger. And I think that the value proposition that reinsurance brings to that space is that we are truly a backstop for the industry, right? I mean, I don't think any one of our cedents could survive without reinsurance because keeping those risks net on their balance sheets, especially if you're dealing with a large surety company with jumbo contractor risks, is an unacceptable proposition from any enterprise risk management, prudent enterprise risk management business.
Right. It was interesting. ASC recently came out with their infrastructure report card. The good news was it got an overall C grade. But I think part of the emphasis in the report is how important it is to invest in infrastructure, overcoming investment gaps. Seems to really underscore the importance of reinsurance as part of the overall equation. Would you agree with that?
I couldn't agree more. And, we write this book on a very diversified basis. So what we try to do is spread our risk out across the industry so we're not getting hit in any one specific space at any one specific time. The challenge for us now is as these risks do get bigger and they do overlap more is we have to be very cognizant of managing that aggregate so that, we can still provide the appropriate amount of capacity, but also not overexpose ourselves. But yeah, absolutely. As the business gets bigger, I think reinsurance capacity gets to be a bigger part of the puzzle.
Well, I really appreciate what Jeff told us about the value of reinsurance. He talked about how things are changing, aggregation of risk, the increase in the size of projects and so forth. That doesn't seem like it's going to go away, right?
Well, that's a great, what, Mark, I think we're at an inflection point. So there was two factors that kind of drove where we are today. One, the Biden administration putting all that money into the system, right, for infrastructure. And then we had, coming out of the pandemic, we had inflation and specifically construction inflation. So you marry those two together and you see the size of jobs going up dramatically. And you're right. When you look at reinsurance, the way we think about it is like what we purchased 10 years ago really isn't adequate today to deal with a loss because the size of the contracts and the projects have gotten 40 to 50% bigger.
Right. So with that said, knowing how important it will be as we move forward, the economy, addressing our infrastructure needs, Brett, tell us a little bit about how important the relationship is between the primary carrier and the reinsurer.
Yeah, a large part of what I do is not just the transaction, but making sure that you have the right partners on both sides of the trade. Our role is to bring people together that believe in the surety's business and really not to be an inhibitor, but to facilitate that stage of growth, that protection. It's all about trust. How are we as partners over the long haul, over the cycle, going to make money together and getting compensated adequately for the volatility protection that you're providing? the industry's evolving, right? There's a lot of new entrants. Capital continues to be attracted to the space. Not too long ago, the surety industry premium was $6 billion. I think SFAA results recently projected in excess of 10.6. And over that backdrop, traditional or surety business has outperformed traditional P&C historically and consistently. And so more companies want to be in the space. The demands that Steve mentioned continue to be, they're growing. The need for reinsurance capital to support this business is at the highest point it's ever been in my career.
Well, that hasn't always been the case, perhaps. Steve, do you remember a time when maybe reinsurance was harder to obtain?
100%, Mark. If you go back,
and why was that?
So I would tell you the last really cycle that affected the surety industry. I mean, I know we had the pandemic, but we didn't see a lot of loss. We had the financial crisis. We didn't see a lot of loss. But you go back to 2002, coming out of what we'll call the Enron event, right? That, and then there was basically a softening in the industry. There was a lot of loss that came out relative to the size of the industry. The industry was not that big back then. So that changed the reinsurers' mentality, and they pushed very hard against the primary companies. So there was a lot of terms and conditions that restricted our ability to underwrite certain classes of business, certain durations. And then it took a good 15 years of good results to kind of unwind a lot of that, right? But if you go back to 2002, there wasn't as many reinsurers because after that event, the Enron event and some of the other ensuing ones, a lot of people just took their ball and went home. There wasn't very many. So I would tell you Chubb had, ACE, because I was ACE at the time, had 5 reinsurers.
Wow.
Today, most surety companies could have 20 plus reinsurers on their program.
Sounds like you need to have a good reinsurance broker in those kind of circumstances, right?
Absolutely. And I think to the 15-year period that Steve mentioned, the industry has had just such exceptional results. And more recently, there has been an increase in frequency and severity across the spectrum. And if you look at those SFAA results, the gross results of the industry still continue to be exceptional. But over the past couple of years, you did see an uptick going from somewhere in the mid-teens to the low to mid-20s. And that doesn't tell the whole story. Because of the U.S. surety market and global, or for those clients that purchase on a global basis, excess of loss is the predominant product. So there's a disproportionate amount of that gross loss being ceded to reinsurers. And so their result might not be that loss ratio in the 20s. And over the course of the past couple of years, my job's been finding the right balance to make those trades sustainable, bringing in the right partners into the relationship, and ultimately keeping those partnerships alive and well.
Yeah, that's exactly what happened. I mean, to Brian's point, you got to a point where it did become a little bit biased towards the primary companies, and they were laying a lot of risk off because over that period, as we mentioned, there wasn't any loss. So we were able to claw back what we had lost in 2002, reduce retentions. But at the same time, when program sizes were growing and there was no losses, then all of a sudden it flips and you're having losses and they're bigger losses and the retentions never changed. The reinsurers took the brunt of the last cycle.
Steve made the point earlier about how firm the market got in the early 2000s, and we saw it get harder than it was, but not to that degree. And I think since the early 2000s, there's been so much additional tools in reinsurers' toolkits in terms of accumulation management, retrocession as a tool to lay off risk, and just a greater capital efficiency within their organizations, and candidly more players to be able to absorb loss and enter and take advantage of changing terms and conditions.
Yeah, I would tell you the industry has done a fantastic job over the last 20 years at improving what I'll call like risk mitigation, like knowing how to credit score, knowing how to like use, digital platforms to aggregate across, all different countries. So now when reinsurers come to us, the data that they get is so much more robust than it was in 2002, where we were dealing with, it was 100% analog. You would get paper files. You'd have to go Excel spreadsheets. You had to put it all together. Now we can produce reports almost in real time. So people feel that they have a better understanding, not only what the risk is, but how much we have of it.
Right.
Yeah.
I wanted to maybe circle back just a bit. So we talked about aggregation of risk, and I think maybe we just touched on the fact that now there are some jumbo projects Could you talk a little bit about how to address that, co-surety relationships, and the role that reinsurance plays in that mix?
Yeah, for sure. Like you're having big projects come out, mega projects. $1 billion is nothing anymore. You have projects that are $2, $3, $4 billion, single projects. So generally what happens is that not too many surety companies will undertake to risk of one single project, right? So what you do is, and it is, I would say, largely the top 5 or 6 surety companies that have been very familiar with sort of kind of working together, right? Harmonizing terms and conditions and indemnities in bond forms in a way that, will be productive to the client. So you'll go into one, and now even more, Mark, where these projects are so big on program size, not just individual, that you're bringing in other sureties. And I think that mentality has changed since the early 2000s, or actually even going further back, to be honest with you. People in the past would have been like, I want to keep everybody away from my client. I think we've grown up, and I think we've said, you know what? We really do need to kind of manage risk in a different way, in a thoughtful way. So that way now you'll see much more participation among the top sureties with sharing risk. And the client benefits the most because they can't have their surety cut off, because then they would end up missing out on revenues, right? So you can't all of a sudden, and it's not like an insurance product. One day you're like, oh, I'm sorry, you know what? The window's closed today. What? Then the guy would be like, oh my God, I'm out of business. Yeah. And like, that's a bad day, right? So I think, we've embraced it as an industry, and I think the clients also see it too.
One of the trends that we're seeing is Steve mentioned the top 5 sureties working together to manage those large jumbo risks. We're seeing the use of co-surety as a risk mitigation and risk sharing tool drop down far below that level, where companies are forming strategic alliances of sort as a way, whether it's with other primary carriers, whether it's with reinsurers, as ways to share in that risk, offset risk, and ultimately be able to provide the capacity that these large projects, these large contractors need to run their business.
Yeah, going to be very important, obviously, to address those infrastructure needs. Kind of circling back, in the current reinsurance marketplace, are there certain things that give reinsurers pause that primary carriers need to know about?
What I found getting the most questions from reinsurers today, right, on the portfolio, has been around like the oil and gas sector specifically, because, and it's a natural question, because why? We've had 2 significant losses that have come out of there. So they're challenging their primary underwriters. Now, everybody has a different appetite and do it differently. That's not, it's not for me to pass judgment on. Right. The other one, and because there's been a fair amount of construction losses that have been owned by private equity. Okay, there you go. So there's another one that you constantly hear about. The other one that you hear a lot about is now the surety behind bank letters of credit, right? Because people are like, well, the surety marketplace is a surety marketplace. It's not a bank. We gave that up in the 20s, right? Then the banks stepped away and surety stepped in to be, the public procurement protection method. So now they're like, well, why are we reintroducing to that? I would tell you, there's always, especially when it comes to distribution, because the obligees drive what's accepted and not accepted. So sometime in the private sector, they only want a letter of credit. So there's always solutions and reasons why you would do or support things, right? Everybody's got to make their own kind of decisions on how to do that.
Our best reinsurance relationships is where there's trust and transparency in the process. It's not intended to be a contentious relationship. If you're supporting a primary surety company as a reinsurer and challenging them on the way they're doing X, you probably shouldn't be supporting that company. And so by matching personalities, by matching appetite with risk, reinsurance is the facilitator of the business. And so when those problem days do occur, when there are losses, when there's challenges, there's an open and transparent communication about not an acquisition or accusation, but rather a transparency and understanding about why they did it, how they're going to improve going forward, and continue the partnership for many years to come.
Yeah.
Well, any final thoughts or things you want to share with those that are listening before we let you guys go?
The biggest thing from my perspective is the surety business is a great business. It starts with the people in it. There's a lot of characters. It's a great community to be a part of. I think most importantly, though, capital continues to be attracted to the space, whether that's primary companies that want to be in the surety business, whether it's reinsurers that want non-correlating diversifying risk. Surety is a great business to to grow in, that's profitable all over the long haul, and we're excited for the future.
Yeah, and listen, I would add that absolutely we need to have reinsurance to continue to run our business, and we treat the reinsurers as partners, and their capital is as important as our own capital, so that we feel an obligation to deliver those good results.
Mark and Kat, I know we're here to talk about Surety, but I don't know if you realize that you have 3 people here with Philadelphia backgrounds. So I think
that's true.
No, this is not an ad for the Eagles, right?
It is.
It
It
is.
is. I'm a Patriots fan, but I do think we have to ask the very important question: what's everybody's favorite cheesesteak?
Oh, that's a good question. This could get contentious. I'd like to hear this.
So I would go with D'Alessandro's, which is probably not the one that most people would pick, but that's my favorite. Yes,
that's 100%. A veteran answer.
Yes.
What was yours?
So I'm gonna let Jeff go first.
Okay, Jeff, let's hear it. The pressure is on.
My kids that went to Villanova said D'Alessandro's for sure. I'm a Geno's guy.
Oh, okay.
I like Geno's steaks better than Pat's steaks. That's on record now. I'm sorry, folks.
So most answers start with Pat's and Geno's. Jim's on South Street. Steve got it right with D'Alessandro's, but the real answer is Angela's in Bella Vista.
Yeah, that's a good choice.
Is there a meat or cheese difference that we're talking here? Sweet peppers.
I'm an American without guy. Very simple.
I have to do provolone with fried onions. That's my specialty.
See, I'm a provolone without.
Yeah,
You're everyone's a little different here today with a lot of Philly representation. Well, Jeff, Brian, Steve, I want to thank all of you guys for being on. I think I learned a lot about reinsurance and even more about which cheesesteaks I need to try next. So,
You've been listening to Let's Get Surety, brought to you by the National Association of Surety Bond Producers. For more information about the NASBP and its members, visit nasbp.org.
Before we go, we just want to say thank you again to Old Republic Surety for their generous support in sponsoring this episode of Let's Get Surety. For more information on Old Republic Surety, visit www.orsurety.com.